BUA Group still making news. The chairman and founder of the BUA Group, Alhaji Abdul Samad Rabiu, has called for the liberalization of Nigeria's cement policy to boost production and subsequently crash the price of the commodity. He attributed the high cost of cement in Nigeria to low production capacity. Rabiu told reporters in Lagos that the price of cement, which presently sells for about 4,000 naira per bag, remains high in Nigeria because the new producers are not able to meet the country's huge demand. Called on the federal government to open up the sector to more competition. Also, other news, Nigeria's government disagrees with the International Monetary Fund's recommendations that it further marks down the currency, the naira, to ease external imbalances. President Muhammadu Buhari's administration sees currency pressures stemming from global outflows caused by the coronavirus pandemic and believes another depreciation would add to double-digit inflation, according to the IMF's Article 4 report for the country that was published on Monday. Joining us to discuss the cement sector, as well as a look at Nigeria's banking sector and consumer goods, is Tunde Abidoye, Head of Equity Research at FBN Quest. Tunde, good morning to you. Thank you so much for joining us. What do you make of the comments of the chairman and founder of the BUA Group? Do they align with your analysis of the cement sector?
Yes, definitely, Rotus. Good morning, and thank you for having me. So definitely they align. That sector is basically an oligopoly, and right now what we're seeing is that capacity utilization rate in that sector is still very low. So what we would want to see is effective capacity utilization moving up to, say, around 70%, and that should increase the volume of product that the sector delivers. In terms of pricing, the prices are still very high when you compare Nigeria's pricing to those of other neighboring countries. I mean, we're seeing close to $130 per ton in Nigeria, and you compare that to countries like Senegal, that's about $80 per barrel, per ton. You compare that to a country like Ghana, it's about $100 per ton. So the cement prices are still high. Definitely, the sector should be liberalized, and just to allow for more players and more competition in the sector.
Fantastic. All right, so FBN Quest, you do have an economic outlook for 2021 where you're looking at other sectors. So we've looked at cement. Looks like you've talked about the oligopoly, high prices, does need to be liberalized. I want to ask you about the financials, about the banking sector. As far as the outlook for 2021 is concerned, based on your report, from a revenue standpoint, how do you see the banks performing this year?
From a revenue standpoint, I mean, let me just decompose the revenues. So in terms of funding income, we think funding income growth is going to be very healthy compared to what we had last year. We were seeing 10 to 15% for the banks within our coverage universe, and the drivers will be loan growth and the NIMs. So for loan growth, we think we're going to see loan growth of around 10%. Yeah, it's going to be lower than what we see. What we saw last year, which was around 20%, but it's still healthy compared to where we were coming from in 2019, where loan growth was practically non-existent. For NIMs, the banks have been able to maintain stable NIMs for the most part because they've been able to reprice their deposit liabilities. So if you look at the results of the banks, you'll see that their NIMs have been relatively stable, despite the fact that the interest rate environment has been low. So those two things we think would help banks from a revenue point of view.
Great stuff. And NIMs, just to help our viewers, that's net interest margin, yeah?
Net interest margins,
okay,
yes.
Great. What about from a regulatory standpoint? So as far as the outlook for banks, how does that look on the regulatory side?
Okay, from a regulatory standpoint, we think regulation is going to remain tight. Sorry.
It's okay. It's okay.
Yeah, we think regulation is going to remain tight, and the CBN is not going to change tack anytime soon.
Okay.
And that's because they had very good results from what we saw last year. Loan growth last year was probably over 20%. And that's because of the CBN's loan-to-deposit ratio policy and policies like the CRR. We don't think the CBN is going to change tack anytime soon.
Okay.
You know.
All right. Do you have any picks as far as the sector is concerned? Do you have picks that include Tier 1 and Tier 2 banks?
Basically, we prefer the Tier 1 bank names compared to the Tier 2 names, and that's because the Tier 1 bank names have better capital and liquidity buffer, so they're able to withstand macroeconomic shocks better than the tier twos. And in that segment, we like Zenith Bank, GT Bank, Access, and UBA.
All right, and okay, I quickly want to jump to consumer goods. What's that sector looking like for 2021?
Okay, so last year, a lot of the names in that sector benefited from government closure of the borders. So we saw names like the palm oil names, for instance, Presco and Okomo Oil, flour mills, and Dangote Sugar actually benefiting from closure of the borders because there was reduced competition from smuggled goods in that space. So coming into 2021, we think that some of those names will definitely come under pressure, for instance, the palm oil names, but we still like the food names. So we like names like Nestle, we like flour mills, we like UAC. We think the upside potential in those names is over 20%, and we think those names will perform better than, the rest of the sector.
Any headwinds, if you can briefly, any headwinds that, as far as like consumer purchasing power, that could affect consumer goods looking at the year ahead?
The potential headwinds, consumer purchasing power has been under pressure for a long time, even before the pandemic. And, what we saw was that the consumers actually shifted to purchasing essential items as opposed to non-essentials. A potential headwind might just be maybe if there's another lockdown that reduce effective demand and slow down growth. So if that occurs, definitely that sector is still going to feel some pressure. Then definitely if inflation, continues to be upward trending as it's done in the last couple of months that we've seen,
Great stuff, Tunde. Okay, we have a minute to go. I want to quickly take you back to banks. I didn't ask you about NPLs, non-performing loans. Yes or no? How's that looking at about 30 seconds if you can?
In terms of non-performing loans, we think asset quality is going to largely remain under control. As we've seen, the Headwinds granted banks regulatory forbearance in 2020, and that allowed banks to actually restructure about 43% of the sector's loan book. And so we think from an NPL perspective, the NPLs are basically under control, and we really don't see an asset quality crisis at this point. Especially when you see oil prices close to around $60 per barrel. The obligors are definitely better able to service their loans, given what we are seeing, especially when you consider that the oil and gas names account for about 26% of the total loan book and NPLs.
Great stuff. Tunde Abidire, Head of Equity Research at FBN Quest. Thank you so much for taking us through that sector outlook. Appreciate your insights.